Think velocity banking will pay off your mortgage faster and save you thousands? Well, you might want to think again. In this video, we expose the hidden risk and costly mistakes that can turn this so-called magic formula into a financial nightmare. So Josh, when we talk about velocity banking, what are we actually talking about, and why is there so much hype around this?
Because it's 5-minute abs for mortgages is exactly what it is.
I want that.
So if you see the competition on YouTube when you make videos about this is to say how fast you can do it. Some people will say 8 years. Some people say 7 years. Some pay your mortgage off in 6 years. Ooh. So it's not a formula where we just plug it into a calculator. Like if you say, hey, if I put in $200 extra a month, how quickly do I pay it off? That's a formula. There are a ton of variables. This is a very complex process. In the most basic, simplest terms, this idea of velocity banking is that you either replace your first mortgage with a home equity line of credit, or you add a home equity line of credit or a credit card. That's how crazy some of these people are. They're taking a 21% credit card will allow you to get debt-free faster. But in essence, what you are doing is taking your monthly income, paying down that line of credit, and then using that to pay out your bills through the month. And the benefit or the difference there, Jeb, is your mortgage is calculated on a monthly basis. A line of credit, whether it's a credit card or a home equity line of credit, is your interest rate times the average daily balance. So what you are doing is reducing your average daily balance so that you're paying less interest, but then also you're essentially doing a principal reduction. So it's a combination of things that are simple and common in other places, but it makes it very complex. And in the real world, the numbers don't really work out the way these folks want you to believe they do.
And we're going to talk about how it can be viewed as a scam. But more importantly, if you're watching this, we're going to tell you how you can actually pay off your mortgage faster, what actually makes sense, what actually works, what helps you get to the finish line faster by paying less interest. But before we do that, I'd like to take a minute and ask a favor. If you find any value in our videos here at all, do us a favor and hit that thumbs up. And if you want to stay updated on everything mortgage and real estate related, do us a favor and subscribe to the channel. So Josh, let's start by talking about the two goals that most homeowners have, which is to get a mortgage or to buy a home, rather.
Well, to become a homeowner.
Yeah,
no one has the goal to get a mortgage, Jim.
Well, it depends, right? To buy a home, which usually comes with a mortgage. And secondly, to pay off that mortgage at some point in the future. And let's talk about how, this velocity banking, accentuates the whole idea here.
Again, no one or very few people would do this today because we're also in a very unique time. To give some context to this, Jeb, I think the first time I heard of this was in the early 2000s. There is a very big bank in Australia, Macquarie Bank. They came into the mortgage market in the US. They were promoting a first position home equity line of credit. And at that point in time, rates were higher. They weren't high, but they were higher, 5.5%, 6%. And with that, a HELOC wasn't much different, especially a first position HELOC, because the benefit to the bank is that home equity line of credit is variable. So rather than locking into making you a 30-year fixed rate loan, they're in a first position and they have a variable interest rate that goes up or down. But the philosophy is if you have a chunk of money that comes in every month, you would pay that down. And then you would use that same line of credit to pay your monthly bills. So just use a real simple example. Let's say you have $10,000 of net income. We don't care about your gross. We care what your actual deposit into your check is every month. If you and your spouse have $10,000 of net income every month and you have your budget, this is an important part to this, Jeb. If you're not a budgeter, if you don't know where every penny goes, this is not the strategy for you. But let's say your budget says we spend $8,800 a month. We have $1,200 extra. In essence, by putting all that money in the account, you're going to have an extra $1,200 principal payment every month. But because it's a line of credit, it's not locked in your mortgage as if you made a $1,200 principal payment on your 30-year fixed mortgage. You could get it back if you needed to. But that $1,200 you're no longer paying interest on. Then in addition, let's say, I looked at the numbers earlier today. If you had $8,000 of bills, it's like $265, $270 daily. So if you accrued $270 of expenses every day, your average daily balance is much lower than if we had that $8,000 for the entire month. So that average daily balance saves you a little bit of interest. In that example, I think it saved you like $150, $200. But the bigger difference is you paid down $1,200 of principal by putting all of your money in there. And then you do it again next month. So we're $1,200 less principal and $1,200 less principal. Yep. So in real simple terms, you are just accelerating the repayment, but you are making your life much more complicated and complex. Think about today, Jeb. We've shown the chart here a million times. If you are currently a homeowner, you likely have an interest rate under 5%. If you're taking out a home equity line of credit today, it's going to be best case 7.5%, maybe as high as 9.5% or 10%. There's no world in which these small amounts of additional principal are going to make up for you paying 3 to 4% higher rate of interest. So mathematically, you can put it into a spreadsheet, and we'll link to a spreadsheet. We weren't going to do the video. There's a guy that's done a 15-minute video that goes through the spreadsheet real clearly and shows you how in a perfect world, there's a tiny bit of savings, but you are increasing the complexity of your life
and
greatly.
The risk. Yeah.
And the risk.
And something to keep in mind here is, I think I'll just go out and say it before we get too deep into the video. I mean, I think the whole thing, scam is probably not the right word, but most people talking about doing this have something to sell, right? They're either selling a first position home equity line of credit, or they're in the home equity line of credit business, or there's some sort of consolidation, something they're doing that makes them want to do this video, because this sort of thing, paying off your mortgage quicker, it's the shiny object, right? It's the gets a lot of likes. People want to do it. How can I make it go away? I want, less debt, all of these other things. So it gets a lot of clicks, but at the end of the day, it's not as feasible as these videos want to make it sound. Is it doable? Absolutely. But it's not the reward that I think most people think it is, because of what we're going to talk about in today's video. And Josh mentioned a video that we watched. We watched a guy go through this where he analyzes different scenarios, consolidating 3 different, monthly debts, a mortgage, all of these different things, and breaks it down on a spreadsheet and really helps you in layman terms understand exactly what's going on. And at the end of the day, there was little to no savings, a lot of complexity, little variability in how you could pay things per month. Like if you decided one month to have a vacation and you change the payment structure on what you're doing, that screws up the entire formula. So you've got to literally do this for an extended period of time for it to ever make sense, which again is a whole different deal.
So let's talk about that, because what does it take to do something consistently that is difficult? When we say something's more complex, it's more difficult than just going into the portal for my lender and setting up my auto payment to pay my mortgage every month. So if you're going to do something that is difficult and you have to do it for a long time and you will slowly see the differences over time, this does snowball. It's almost sort of like Dave Ramsey's debt snowball in terms of you're just decreasing what you're paying interest on. So let's just kind of step back and look at it from that perspective, Jeb, before we even go into the details of your other alternatives. There's no magic here. What they're saying is you're going to pay less interest. And this is not by getting a lower interest rate mortgage. It's by having a smaller balance that you're paying that interest on. So rapid prepayment, and that's not magic. We can prepay. We can throw anything into the calculator and show you what it is and give you much more certainty, much more flexibility, and the certainty of a fixed rate mortgage. Whether you want to do a 30-year, a 20-year, a 15-year, you can have all of those things. So what I will say, Jeb, is literally, 20 years ago, I first became aware of these. I've only ever seen 2 people do them, and both of them botched it terribly and came back to us to put normal financing in place. Does it mean they were idiots or they were bad people or they didn't know how to manage their finances? Not really. It means that it's complex and the real world is a lot different than a spreadsheet.
We're going to talk about this, but the only way to pay off your mortgage faster is to pay more towards your mortgage every single month. I mean, that's in simplest terms how you pay your mortgage off faster. So to backtrack, Josh, you started the video by talking about paying off your mortgage in 7 years, paying off your mortgage in 8, 9, whatever the number is, because that's how some of these videos are titled. And so is that realistic? Can you pay your mortgage off in 7 years? And if so, what does that take? What
Absolutely.
does it take to pay off your mortgage in 7 years?
We use that example of a household with $10,000 a month net income and monthly expenses of $8,000 or $9,000 a month. That is not going to pay that off in 7 years. It will reduce it. It will reduce the term, but it's not going to reduce it to 7 years. We could look at your normal 30-year fixed mortgage and say, if we took an extra $1,200 principal payment, how much is that going to shave off of it? It's not going to shave 23 years. So who could it work for? Let's say you're a business owner and you get $50,000 of money coming in and you have $30,000 going out, including your business bills. Now that person is paying the mortgage down $20,000 a month, $20,000 a month, $20,000 a month. And at the end of the year, they might have to go to that line of credit and write a $100,000 check to the IRS for their taxes. But throughout the course of the year, they saved $6,000, $7,000, $8,000 on the interest by reducing that line of credit. So really, who could it work for? Someone that is very regimented and budgeted, so they know where their money goes, is very consistent in terms of month to month. Because if you're a business owner, Jeb, we know folks that, they make $500,000 at the end of the year, but they might make $85,000 one month and $15,000 the next month. So disciplined, budgeted, consistent, and preferably having a big chunk of additional income, net income left over after their bills are paid at the end of the month. And then even at that point, Jeb, we have to ask ourselves the question, what about the opportunity cost of that? Would that same person be better off taking that additional $20,000 a month and putting into a high yield savings account? Are they comfortable investing it? Is it short-term money that has to be used for paying their taxes at the end of the year? Probably not. At this point, if you're listening, you probably got hooked by saying, hey, how do I get my mortgage paid off in 7 years? But you're hearing, wow, that's difficult and complex and probably not likely to work for me. And that is the correct answer when we're talking about velocity banking.
Well, Josh, you see a lot of people's finances. You see a lot of debt to income ratios, a lot of just debt, credit reports, that sort of thing. Do you think the majority of people are capable, just based on what the complexity? You see bank statements, you see all their assets. Like when I think of this, I think it's complex. I mean, I'm not 100% have my stuff together with regards to where every dollar goes or anything like that. But I understand this enough to go, this is crazy. Like I would just rather put a little bit more money every single month towards the principal balance. And yeah, you don't pay it off in 7 years, but maybe you cut that 30-year fix down to a 25 or 24-year loan, depending on, how much you're paying every month. And we'll kind of walk through those examples. But, what do you see?
I would say less than 1 out of every 10 buyers is that level of disciplined. And then we're going to narrow that field even more, that a lot of those people that are disciplined because they need to be. They know, hey, down to the penny where every dollar is going, including money to their 401k or their IRA or whatever investments they're doing to also prepare for retirement. So most people aren't that level of focused, detailed, disciplined, and budgeted. And then on top of that, most of those people are not the type of person that has this extra float of additional money every month that makes the spreadsheets for velocity banking look so sexy in terms of being able to greatly reduce the repayment period of your mortgage.
Got it. So now let's talk about drawbacks of what it. We've kind of gone over a little bit of it, but drawbacks, and then we'll kind of go into alternatives, right? What actually works when paying off your mortgage quicker? But let's start with those drawbacks that we kind of discuss some of them right now. You mentioned opportunity cost is one of them. What are some other things?
Well, we talked about you have to be disciplined. You have to be willing to tolerate complexity. There's an opportunity cost. You are deciding this is the best way to invest my additional funds every month to get me where I want to go. So those we already kind of covered.
And let's start there, Josh, because if we're talking, I saw a new stat today, 23% of mortgage holders at the moment have an interest rate above 5%. Okay. So, do the math. What's that? 77% of people have a mortgage below 5%. So once you get to a point where your interest rate's 2.5%, 3%, there's really, there's no reason to do what we're talking about here to some degree, because you're basically free money, and you're able to really generate, like, that opportunity cost is a lot bigger. But when you're getting an interest rate that's 7 or 8%, right, which some people are right now, is there a greater benefit at that point to try to pay the mortgage off a little bit quicker? Is it the same?
In the big picture, it's the same. There's a reason why yields across the board are up. You can get more on your savings at the bank. More likely, an internet bank will give you the best yield, but there's a reason why you're paying more. There's a reason why you're getting more. And then who knows what in the world's going on with the stock market? It's been on fire for years now, and people are saying those numbers can't last. So in terms of big picture, I don't think it does really change things. But for those 77% under 5%, when you're saying there's no way to cross this gap of getting a home equity line of credit. Say I owe 300 on my first and my house is now worth 500. I could go get $100,000. Why would I pay $100,000 from my variable line of credit down on my low fixed rate? Just because I'm going to put money towards it at a rapid rate towards the beginning of the month. So if you're listening at home, it's probably going way over your head because it is. It's unnecessarily complex. And in the current environment, most of these videos, if you look, they've been up for more than 2 years. We've been in a high interest rate environment for the last 2 years. When most people have very low interest rates, you're not going to trade low fixed rate debt for higher rate variable debt. And there's interest rate risk in this. That is one of the downsides to it. You are looking at a line of credit. Any line of credit is not going to have a fixed rate. It is going to be variable. And most people are not comfortable with that. Even with rates higher, they still prefer the certainty of a 30-year fixed. We still have way less than 10% of the market share of first mortgages is adjustable rates because the legal environment post 2008 in the US makes them much harder to do, but people don't want them. They like the security of having a fixed rate. The other potential here is you're taking on additional debt, some type of line of credit, and the risk with that, when you have additional credit available to you, you use it. So the goal here is to pay it down. I will tell you, the gentleman that we helped get out of his situation last year owed more. First of all, he had no idea what his interest rate was. He told me it was like 4% lower than what he thought it was. I'm like, that's amazing. Let me see the line of credit agreement. We get it. We're like, you're like 9%. You're not at 5%. Like, oh my God, I am. And I said, and you took this out at this amount and now you owe this amount. No, it's supposed to be paying it off way faster. And, it was a grossly inappropriate product for him. He did not have any of the prerequisites that we just talked about. He didn't have the discipline or the financial savvy to even understand what the product was. So you have that potential of increasing your debt, and just big picture kind of wrapping up all of those downsides is just limited applicability. It doesn't apply to most people. And again, go back and watch the gentleman's examples. You can see in a perfect world, his spreadsheet shows a very, very minimal benefit, like paying off the debts like a month earlier for all of this increased risk, complexity, difficulty, headaches in your life.
All right, Josh, let's talk about alternatives in paying off your mortgage. But before we do that, determining if, prepaying your mortgage is actually feasible. Is it something that is doable for you? Is it something you should be doing? So how does one go about looking at that?
We all would love to be mortgage free, right? If someone said, hey, Jeb, would you like to have your mortgage paid off tomorrow? You'd say yes. I mean, you might also say, well, how am I going to do it? Where is the money coming from? And those are important questions. But in general, the answer is, yeah, that would be awesome to not have to make a mortgage payment the beginning of next month. But we got to look at a couple of different things. Before we start figuring out how we're going to rapidly prepay our mortgage to get mortgage free, we need to say, how liquid are we? A lot of people, I mean, you've seen the numbers. I don't have them here in front of me, Jeb, but most U.S. households do not have sufficient liquid reserves. So first, get 6 to 12 months of household expenses saved up before we start locking it into a mortgage. If you have one of those great COVID era 3% 30-year fixed mortgages, if you prepay it, if you put an extra $1,000, $5,000, $10,000 down it, it's locked in there. You can't get it back. And if you do, you have to borrow. You have to be pre-approved. You have to pay costs. You have to borrow. And it's going to be at a higher rate than what you have. So be very, very careful about prepaying the ultra low mortgages out there. If you have a more recent vintage mortgage at 7%, you pointed out, Jeb, those people are interested. They are much more interested in going and putting an extra $100 or $200 a month. And that can be a good decision because it will save you money and years over the long haul. But that's my first question. Do I have enough liquidity? And then let's say I do. Let's say I have 12 months of my living expenses in a savings account that I don't touch. All right. Now it's perfectly appropriate to consider making additional principal payments. But then I got to say, am I getting a better return somewhere else? So again, depends on, did I buy in 2023 with a 7% mortgage or did I buy in 2021 with a 3% mortgage? If I have a 3% mortgage, I'm probably better off if I have an additional $500 a month funding an IRA, putting it into my 401k somewhere where it's tax advantage can grow deferred for all of those years. So that's what I want to consider. Now, if you have that higher rate, you're at 7%, you're at 6.5%. Now it can make sense. And I just want to look at this, show you all of these examples we're going to use are a $400,000 mortgage at 6.5%. That's a little bit better than where rates are at right now, but it's a very common loan size for first-time buyers throughout the U.S. If you were to pay an additional $450 a month, it cuts off 10 years. Basically, it turns your 30-year mortgage into a 20-year mortgage. That is a good thing for most people if they can afford the additional $450 a month. But that's not the only way to get there. Answering that last question, if you were to take that $450 a month and get 8% yield on it, in 20 years, you have $266,000 and your mortgage balance would be $222,000. So you have an extra $45,000, or you would have paid it off in 16 and a half, 17 and a half years, somewhere in that time frame. So if you are a good saver, you're disciplined and you're comfortable investing and getting a higher yield than what your current mortgage rate is, then we would probably want to consider that, because the last element of deciding if prepaying your mortgage makes sense is, do I get a tax benefit? And pre-2018, it was 2017, I believe, Jeb, the tax changes, the changes in the tax code, we have a much larger standard deduction now than what we had previously. So for this year, married couple is $29,200 as far as your standard deduction, $14,600 for someone filing individually. But let's look at that. That same $400,000 loan, the first year at 6.5%, you're paying a little less than $26,000 of interest. It doesn't exceed the standard deduction for a married couple. So a lot of people, when you pencil it out, just taking the standard deduction and simplifying your life is easier. Now, if you have a $700,000 mortgage and you have lots of other itemized deductions and you're getting a big benefit in terms of the taxes, then it can make even more sense to keep that mortgage longer. So those are the things that I always like to go through with the client. Are you liquid? How comfortable are you saving and investing elsewhere and being diligent and dedicated and getting there? And are you getting a significant tax benefit from carrying the mortgage longer while you're in your prime earning years? So that's what I like to go through with clients to determine if it's appropriate to prepay the mortgage.
And I think this goes without saying, but Josh is not a CPA. I'm not a CPA. He's not a financial analyst, an expert of any means. This is not advice by any means. So talk to CPAs, talk to your tax professional about this sort of thing, right? Strategy and what makes the most sense based on where you are. Now, Josh, back when I did loans, I would have people come to me and say, hey, Jeb, I want a 15-year fixed, or I want a 20-year fixed. And because I'm trying to pay off my mortgage faster. And so I always try to convince people to take a longer term mortgage because what if something happens? What if you are no longer in a position to continue to pay off that 15-year mortgage? Now what? Now you've got to refinance. Now you've got to sell. There's different options to get you out from underneath that debt. Whereas if you took the longer term debt and paid it like it was a 15-year fixed mortgage or a 20-year fixed or whatever the term is, you have flexibility, right? You can pay that term 1 month or for as long as you want, and something happens financially, you get medical bills or whatever. Now you can pay it like a normal 30-year fixed. Nothing changes. All is good. Now, there's some benefits to a shorter term mortgage. Lower interest rates are one of the biggest things. Pay less interest over the period of the loan. But is the benefit there? So Josh, in paying off your mortgage, what are your thoughts on taking a shorter term mortgage?
Well, let's underline what you just said. We had a listener to the show, what was it, probably 90 days ago, reached out, Jeb. They had, in 2020, when rates first dropped, they got a 30-year fixed at like just over 3%. Rates dropped further. The mortgage person called them up and said, hey, I can get you guys a 15-year at 2.125, an awesome deal. And they took it. Well, flash forward 2 years later, and the husband had lost his job. They had run up significant credit card debt. Their best asset was a lot of equity in their home, and they weren't comfortable with that much higher payment. So they were asking us, is it insane to go and do a 6 3/4 cash out refinance of our 2.125 loan? And cash flow wise, it was going to reduce their monthly payments like $2,500 a month when their household income had been cut in half. So we looked at it and go, yeah, it makes all the sense in the world. But they told us, we would be fine if we had just stuck with that 30-year fixed.
Yep.
So they had something really good. They went to something that was more aggressive, better. You could define it as better, but in the long run, it didn't give them the optionality of that 30-year fixed, which they could have paid additional principal payments on. So when we look at that, Jeb, always want to go through the numbers, and going back to, it is as simple as the more principal you pay, the lower your balance is, whatever your interest rate is, the less total interest you're going to pay. That's how we're shortening the term. So let's go back to our example, 400,000 at 6.5%. The principal and interest on a 30-year is 25.28. We can shorten that to 25 years with only an additional $172 a month. If we want to take it down 20 years, we already went through this, $454 more a month.
To 20 years, not take it
down
20 years.
Take it down to a 20-year loan.
Right.
It increases that payment $454 a month. Most people could consider an additional 172. 450 starts getting big. If we drop that down to a 15-year, it is $956 more a month. So you cut the loan term in half. You're going to save a ton of money, but cash flow wise, most people are not comfortable with another $950 on their monthly payment. And occasionally I'll have someone that's super aggressive, super conservative. Maybe they're doing a small mortgage. Say, I want a 10-year loan. In this example, a 10-year loan adds $2,000 to the monthly payment. So for most people, if you want to be more conservative, you want to prepay this, look at a 25, maybe a 20-year term. You're not going to get a huge interest savings like you will by dropping down to a 15 or a 10, but it's giving you a much more reasonable monthly payment. One of the other things, Jeb, that we hear all the time is, I want to do biweekly. I hear biweekly. There's nothing magic about a biweekly payment other than you are making 26 half payments a year. So it's 13 payments. You're making an additional payment. So what does that do? In this example, you would pay $1,264.14 26 times a year. So it's essentially you're paying an additional $210 a month. Well, we talked about a 25-year loan is $172 more a month. You would pay it off in about 24.1 years. So what I always tell people is, don't get hung up on the biweekly. The magic is not in the biweekly. The magic is in the additional principal payment. So if we take that additional $210 and just put it with your normal monthly payment, it takes it down to 24.15 months. So you're like 2 weeks longer to get that mortgage paid off. But you can simply, in your portal with the lender, say, I want to make my principal and interest payment, and I want an additional $210. Again, and that's personal preference. If you want to set up a biweekly, by all means, go ahead and do it. A lot of the lender portals will allow you to structure it that way. For me, I want simple. Let's just make it simple. And if for whatever reason things get tight, it's the holiday season, I need a little extra cash, I just go and turn off the additional principal payment. They're all going to do the same thing. They're going to get you to arrive at a point in the future where we have extinguished the mortgage sooner by making additional principal payments, including velocity banking. It is simply that simple. You're paying less interest by on the average or on the average daily balance being lower with those additional principal payments.
Yeah, and if you're considering velocity banking, you're considering that sort of thing, just make sure you talk to more than one person, right? Talk to somebody that's for it, and then talk to somebody that understands it and can break down the complexity of it in a way that's, easier for you to understand. Maybe you fully understand it to begin with and you're ready to go. But I think for most people, there's a lot more to it than just, hey, this pays off your principal faster. There's a lot of complexity to it. Like I think we've maybe gotten across here, Josh. But with that, if you're in the business of getting a mortgage, refinancing, doing cash out, that sort of thing, reach out to us. We have a lot of people reach out that we can't actually help. Just asking questions and wanting some advice, we're able to give that, but we can also help guide you through that process. So if you're in need of a refinance, you're in need of getting a loan, you just want a second opinion, reach out to Josh and the team here, and we can definitely guide you in the right direction. But Josh, let's sum up velocity banking in one word as we exit today. What is it? One word.
Unnecessarily complex. There's two.
You could just say unnecessary. Unnecessary might be the right word. But either way, guys, we appreciate you watching. Let us know what you thought of the episode in the description below. Until next time, buy right, borrow smart, build wealth. Adios.
Amigos.